Hello, class. Today we are going to learn, we're going to look at the introduction to basic exchange rate concepts. And we can say that an exchange rate is a rate at which a unit of one currency can be exchanged for another. So for any currency, there is an exchange rate for each currency it can be traded with. So I'm going to write that an exchange rate, so we are looking at exchange rates. So an exchange rate is the rate at which a unit of one currency can be exchanged for another. So for any currency, there is an exchange rate. For each currency, it can be traded with. So for each currency, there is an exchange rate. For each currency, it can be traded with. So that's what an exchange, that's an exchange rate. An exchange rate. So we're going to look at some exchange rate concepts, and there are three concepts involved in the way in which exchange rates are expressed, which must be understood. There are three concepts of exchange rates that must be understood or expressed for us to understand actually the foreign exchange market. So the three concepts we're going to look at, we have the buying and selling, value of one currency against the other one. So we also have buying and selling. So buying and selling price. So value of a pound against other currencies, value of a pound against other currencies. So we just want to see how they are actually expressed. So we have the US dollar, which is 1.9695 and 1.9718. Then we have the euro. 1.27110, 1.2734. Then we have the Japanese yen, which is 207.840. And 208.1. So this is how the rates are actually expressed. When you go to the bank, you'll find that the rates are actually expressed like that. And this is actually the buying rate. This is the buying rate, and this is the selling. This is what we call the bid, and this is what we call the ask. So a person in Britain is going to sell, or the bank is going to buy dollars from him, dollars from an investor at 1.69 so that he can get sterling pounds. So if he has any dollars or some amount of money, he's going to sell the bank is going to buy from him at 1.969. If he has any amount of sterling pounds and he wants what? And he'd like some dollars. And you'd like some, no, it's not like that actually. Is that at 1.718, the bank in Britain is going to sell sterling pounds at 1.9718, is going to sell sterling pounds to an investor who would like to get what? Sterling pounds. And that person is, let's say, in what? That person is in Britain. So what is going to happen? He's going to be sold to sterling pounds at 1.718. Then, if he wants to, if the same investor wants to sell back the sterling pounds to the bank is going to buy them at 1.969. Why? Because the bank has to make some profit. So the difference between the buying and the selling is what we call the spread. So the bank has to make some profits, and that's why it is going to buy sterling pounds at 1.969 and sell sterling pounds at 1.9718. The same applies to the euros, that the bank is going to buy euros at 1.7110 and sell euros to any investor who wants to sell, who wants to buy. That I want to have some sterling pounds. So if I want to have some sterling pounds, I will go to the bank, and the bank is going to sell to me at 1.97334. The bank is going to buy from me at 1.2734. And if I have sterling pounds and I want to sell them back, I will sell them at 1.2710 euros. The same applies to the Japanese yen. The same applies to the Japanese yen. So we can say that the lower of the two rates, is the price at which the bank will buy sterling pounds. For example, this you can write, for example, sell dollars in return for sterling, and the higher is the rate the bank will buy the higher is the rate the bank will buy the exchange currency. For example, sell pounds for dollars, this I've already explained. So the wider the spread between the two quotes, the higher the profit margin. The wider the spread, so the spread is the difference between the buying and selling, or the difference between the bid and ask price. The bid and ask price. So I thought it was important that we get to understand these concepts. Then the other one is the forward exchange rate. The forward exchange rates. The forward exchange rate is a currency exchange rate. Let me just write it. A forward exchange rate is a currency exchange rate for an exchange. But before we look at the forward exchange rate, I thought we should have looked first at the spot exchange rate, but it's okay. Let me just write that. So a forward exchange rate is a currency exchange rate for an exchange to be done in the in the future. So forward rates are quoted for various futures. Let me just write that forward rates are quoted for various futures dates, for various future dates. Like, let's say, for example, e.g., we can say e.g. like 30 days, 60 days, or 90 days, So we can say that a forward exchange is actually an agreement to exchange a specific amount of currency, of a specific amount of one currency on a future date, which has been specified, in the forward contract, Before we go so much into the forward exchange rate, I would like us to look at the spot rate. Would like us to look at the spot rate. A spot exchange rate, maybe I can write it here. Spot exchange rate. Spot exchange rate. A spot exchange rate is the currency exchange rate for immediate delivery, which for most currencies means exchange currencies takes place 2 days after the trade. 2 days after the trade. 2 days after the trade. So we are saying the spot exchange rate is a currency exchange rate for immediate delivery, which must be for immediate delivery, which for most currencies means the exchange of currencies takes place 2 days after the trade. So what we are seeing here, what has been quoted here, the buy and the selling price, these are actually spot exchange rates. That you will enter into an agreement if you're in trade and finance, or you want to sell something or buy something from abroad. You're going to use these rates as a spot exchange rate. But sometimes we use forward exchange rate so that we can hedge against risk. So I was also explaining about the rates, that the value of two rates is the price at which the bank will buy. Let us just go back here. The lower of the two rates is the price at which the bank will buy the sterling pounds. So yeah, so that I want us to look at a small example as we try to explain about the forward exchange rate. I have told you the spot exchange rate. These are the rates that are quoted every day in the bank or in forex bureaus. So we're going to look at a forward exchange rate example. We're going to look at a small example for us to understand the concept of forward exchange rates. And usually many people will enter into forward exchange rate because they want to hedge against risk, because they are supposed to get some amount of money. Maybe they have sold some goods outside the country, and they expect to be paid some money. They expect to be paid some money, and in foreign currency, maybe 30 days from now, 15 days from now, 2 months from now, 3 months from now. And because of the fluctuations that we find in the foreign exchange rate, each client or each investor or each person who is in the business of trading using trading outside the country will find it fit to hedge against the fluctuations of the foreign exchange, what is actually happening in the market, because the rates change every day. And why do they change? Because interest rates change every day, and situations in countries, macroeconomic factors always affect the exchange rates, the growth in that country. Maybe they have decided to devalue. And you can remember, like, was it in 2018 or 2017 thereof, when, okay, of course, we have all these Kenyan banks that were actually that have actually expanded to the East African countries. And for many of the banks have got, like in Kenya, like Equity Bank, KCB Bank, and I think even that time, I think, I don't know whether Standard had gone to Southern Sudan. They went to Southern Sudan and invested in the business of banking and all that. Then guess what? The government of Southern Sudan decided to devalue their pound. And when they devalued their pound, you can imagine what happened. Most of these banks, I remember the following year, like KCB reporting 700 million loss, Equity reporting about 600 or 500 million loss, and other banks, because what did they do? They had invested outside, and after investing outside, the money that they had invested outside, actually, when it came back, or compared to when it came back, or when we look, when the accounts were done, and we're trying to look at what is the value of our investment in Southern Sudan, the value had actually gone down. Why? Because Southern Sudan had decided to devalue their what? To devalue their pound. So for each investor, it is so important. If you're going to receive money a week after, it is important that you get into a forward exchange rate. And a forward exchange rate is going to help you to mitigate risk. It's going to help you to hedge against unforeseen risk in the foreign exchange market. From a week to 15 days to 30 days to an year to 60 days, it's important for us to hedge against risk. So we're going to look at a small example, and we're going to say a Kenyan farm. Let me just write it here. A Kenyan farm that receives 10 million Great Britain pound from Britain farm 6 months from now has uncertainty about the amount, about the amount of Kenya shillings that payment is uncertain about the amount of Kenya shillings that payment will be, about the amount of Kenya shillings that payment will be in 6 months. 6 months from today, 6 months. From now. So by entering into a forward agreement, covering 10 million, into a forward agreement, or by entering into a forward agreement covering 10 million, covering 10 million, covering 10 million, covering 10 million, covering 10 million. So Great Britain pound at 6 months, at 6 months forward rate, is 130. Great Britain pound, Great Britain pound the company has, okay, so the by entering into a forward agreement covering 10 million Great Britain pound at 6 months forward is that, of course, we can also add here that the spot exchange, that the spot rate today is about 128, 128 Great Britain pound. Yesterday we were told the spot exchange rate was 129. Great Britain pound. Great Britain pound. So the Kenyan company, you can say, the Kenyan company has agreed to exchange 10 million for Great Britain pound for 1.3 billion. 1.3 billion Kenya shillings, 1.3 billion Kenyan shillings in 6 months. Of course, even when you enter into this agreement, of course, you pay a commission, but we shall look at that much later when we are looking at locational arbitrage, when you're looking at covered interest arbitrage. We shall look at that. So 1.3 billion Kenya shillings in 6 months. In 6 months. So I'm going to explain to you a little bit about what this, we shall look at how we express the rates, yeah. So this is 130 Kenya shillings. We can put here Kenya shillings for Great Britain, for the Great Britain pound. So it means that 130 Kenya shillings, 130 Kenya shillings is equivalent to 1 Great Britain pound. So if that is so, we're going to take 130,000, we multiply by the 10 million, which the Kenyan company is supposed to receive in 6 months. So this is an example of using what? A forward rate. Instead of using the spot rate, he covers himself, because at that, the spot rate after 6 months, could be, let's say, we can also say that the spot rate in 6 months is what is 130, is 125 shillings into Great Britain pound. So what we can say is that the trader is much better hedging against the foreign exchange, against the amount that is going to receive in terms of foreign exchange, in terms of the Great Britain pound. You can see if the trader had thought, anyway, I'm receiving 10 million in 6 months, that's quite a lot of money. I can wait for that particular time and use the spot exchange rate. Because exchange rate keep fluctuating, he would have lost, because that means he would have received 1.250 billion instead of 1.3 billion. So it is always important for traders, if they expect money in the future, to hedge against the foreign exchange risk. So an exchange rate is simply, of course, we are going to, well, let me see where my notes, how my notes are. So we can say, let me just, because we're looking at exchange rates, let me just say that we're also going to write that an exchange rate is simply an exchange rate is simply the price or cost, of units of one currency in terms of another, So an exchange rate is simply the price or cost of units of one currency in terms of another. So just to explain a little bit, so let me say 1.416 US dollars per euro. What does that mean? I'm just trying to see if you have understood how we interpret the cost of one currency, in terms of another. So what does this mean? That 1.416 US dollars to a euro. What does it mean? What does it mean? It means that each euro will cost 1.416 US dollars. When it is expressed like that, that is going to cost, it means that each euro will cost 1.416 US dollars. So if you can react to this, of course, it means what the backslash, which is here, the backslash as per, it means as per. You will have no trouble actually trying to understand. If you can try to understand this, that it means what as per. So it means that the US dollar will cost 1.41 shillings per 1 euro, per 1 euro. Or you can imagine, let's take a previous example. How are we going to express like what? 130 Kenya shillings per what? 130, or let's say not 130, we can say that 130 Great Britain pound per what? Past 130 per Kenya shilling. How can you express that? What does that mean? It means that each for each Kenya shillings, for one Kenya shillings, no, it means, what does that mean? That for each Great Britain pound, it is going to cost 130 Kenya shillings, yeah? Let me just put it here, that it means that each Kenyan, let me say Kenyan shilling will cost for each, it means that for each Kenyan shillings will cost it means that for each Kenyan shilling will cost euro 130. So it means that for each Kenyan shillings, for each Kenyan 1 shilling, let me put it for, it means that for each Kenyan 1 shilling, for each Kenyan 1 shilling, it will cost Great Britain pounds 130. So for a Kenyan, it means that for each Kenyan shilling, 1 shilling it will cost Great Britain 130. It means that for me to buy 1 Great Britain pounds, I will need 130 Kenyan shillings. For me to buy 1 Great Britain pound, I will need Kenya shillings 130. So far, so good. So in a foreign currency quotation, we have the price in one currency, in units of another currency. These are often referred to as the base currency. Maybe I also need to write that. This is just a few concepts that we need to understand before we launch into the foreign exchange market when it comes to trying to do what? Trying to calculate the forward rates, the hedge, the covered interest arbitrage, the purchasing power parity, and all that. So in a foreign currency quotation, we have the price of one currency in units of another currency. That we've already said many times, that in a foreign exchange quotation, we have the price of one currency in units of another currency. So these are often referred to as the base currency and the price currency. So let's just write that in foreign exchange quotations, in foreign exchange quotations, we can say we have the price of one currency. So these are often referred to as, it's important for us to understand base currency and price currency, often referred to as, these are often referred to as base currency and the price currency. And the price currency. Yeah, we usually have the base currency and the price currency. So we're going to look at an example. So in the quotation, let's say in the quotation 1.25 US dollar to the euro, the US dollar is the price currency, and the euro is the base, I hope you can see, is the base currency, is the base currency. So in the quotation 1.25, we say that the US dollar is the price currency. It's important for us to understand this. And the euro is the base currency, and the euro is the base currency. And what does it mean? That for each euro, it is going to cost 1.25. For each 1 euro, it is going to cost 1.25 US dollars. 1.25 US dollars. So of course, we can say that the price currency is stronger than the base currency. So the price of 1 euro, that is the base currency, is 1.25 US dollars, which I've already said. And that is what, and this is what the price currency, it's a price currency. The price currency of 1 unit of the base currency in terms of the other. So maybe I can write and say, so 1.25 is the price of one currency, is the price of one currency, is the price of one, is the price of one currency. So 1.25 is the price of one currency of the base currency in terms of the other. So it may help to remember that the euro, in this example, is the bottom or base. The euro is the bottom or the base. of the exchange rate given in terms of US dollar, given in terms of US dollar per euro, given in terms of US dollar, given in terms of US dollar per euro. So also to understand that there are many foreign currencies that are expressed in the foreign exchange market. There are many currencies that are expressed in the foreign exchange market. And for us, it's important to know, of course, the way they are quoted, just like the way we had done previously. The way they are quoted, we have like the Japanese yen. The Japanese yen is written how? Japanese, let me see. The Kenya shillings, the Japanese yen. So usually they write what? They write like the first, they have like 3 letters. They have like, we have like 3 letters. We have 3 letters. We have the Japanese yen, we have the Kenya shilling, the Japanese yen, we have the Kenya shillings, we have the US dollars. So it is important for us to note that the first two digits represent the country of the currency. The country of the currency. So you can see like the Kenya shilling, we have KE that represents Kenya. The Japanese yen, we have these two, which represent Japan, and then we have their currency, which is called the yen. And then for US, we have the US dollar. When you go to the foreign bureaus or the foreign exchange, or even in the banks, you will find them expressed like this. Of course, like the way we had expressed them in the bid and ask price, but you'll find that they are expressed in what? Like they will quote the Kenya shilling, the Japanese yen, and the US dollars. And of course, they will quote what? The bid ask price. But just to know, the first 2 digits represents the country of the currency, and the last one represents the currency of that country. So for the Kenya shilling, we have KE representing Kenya, and then S is shillings. The Japanese, we have GP, and then Y is the currency, which is the yen. The US dollar is US, and then we have the dollar. So important to understand those quotations and how they are expressed. So now we're going to go to something else. We're going to go to the direct and indirect quotations, the direct and indirect quotations. Direct and indirect quotations. We're going to go at direct and indirect quotations. So we're going to go to direct quotation. So direct quotation, we can say that the direct quotation is number of units of domestic currency, number of units of domestic currency per unit of foreign currency. So that is our direct quotation. Number of units of domestic currency per unit of foreign currency. Per unit of foreign currency. And then we can say that the indirect quotation, we can say number of units of number of units of domestic currency, per unit of foreign currency. So indirect currency, number of units of foreign, indirect currency, number of units of foreign, number of units of foreign currency per unit of domestic currency, so number of units of foreign currency per unit of domestic currency, That is how they're usually expressed. So always to remember that the direct quotation is number of units of domestic currency per unit of foreign currency, and then the indirect quotation is number of units of foreign currency per unit of domestic currency, So I'm going to just maybe draw a small diagram here just to have a visual of how they are. So we're going to have, say what, direct and indirect quotation. Is it quotes? So we're going to have here we have foreign exchange, we just say foreign currency. Let's just say what, foreign currency. It's better. Foreign currency. And then we're going to have here home currency. So 1 unit, home currency 1 unit is the indirect quote. And this 1 unit of foreign currency in our home currency is what we call the direct quote. So whenever we express the foreign exchange in 1 unit, it's called the direct quote. Let me just write it. That whenever we are expressing the foreign currency in 1 unit, is called the direct quote. So whenever we are expressing the foreign currency in 1 unit is called the direct quote. So for $1, it is going to be Kenya shillings 104. Yeah, so that's a direct quote. Yeah, that's a direct quote. But when we say 140, 140 USD per Kenya shillings, that means 140 US dollars per Kenya shilling. That means that for 1 Kenyan shillings, it is going to cost, what? For a Kenyan, for 1 US dollar is going to cost Kenya shillings 104. 104. So that is a direct quote. That's a direct. For each 1 US dollar, shilling is going to cost 104. So for 1 US dollar, it is going to cost Kenya shillings 104. This is what we call the direct quote. And this is what we call the indirect quote. This is what we call the indirect quote. So for home currency in the 1 unit is the direct quote. Home currency in 1 unit is the direct quote. So whenever we express the foreign currency in 1 unit is called the direct quote. Then, but also we can get what? We can also get the direct quote from the indirect quote. Sometimes you can be given the indirect quote, and of course you're told to give what? The direct quote of a currency. So we're going to see how, it's just a small formula. And it's usually the inverse. For us to get the direct quote, we get the inverse of the indirect quote. So direct quote is equals to 1 over the indirect quote. Yeah, so the direct quote is equals to 1 over the indirect quote. Then the indirect quote is equals to 1 over the direct, 1 over the direct quote, 1 over the direct quote. So far, so good. So we can look at an example. I don't know whether I have an example to see how we can get what? The indirect quote. So if we have 1 US dollar costing Kenya shillings 104, so we can get the indirect quote by actually getting the inverse of that. So let us look at something else as we go on. So we're going to look at what? We're going to look at cross exchange rates. Cross exchange rates. We're going to look at cross exchange rates. And usually cross exchange rates will occur because the foreign market is not, there is the currency that we want to get the value of is not traded much. So it is, or it is not actually quoted, or it's not fully traded much. So what is going to happen? We're going to look at the cross exchange rates of one currency expressed in terms of a common currency. And also, like, we also check another currency that is expressed in terms of another, and we try to find what is going to be the cost of the third currency. Maybe I can write down so that we can get to understand what it means, that across exchange rate is the exchange rate between two currencies implied by their exchange rates, implied by their exchange rates, with a common third currency. With a common third currency. So a cross exchange rate is exchange rate between two currencies implied by their exchange rates with a common third currency. So cross rates are necessary when there is no active forex market in the currency pair. They are important. You can write that cross rates are necessary when there is no active forex market, in the currency pair. So the rates must be computed from the exchange rates between each of these two currencies, each of the two currencies, and usually mostly, because many foreign currencies are expressed in terms of dollars. Of course, we're going to use the third currency as maybe the dollar or the euro or the Great Britain pound. So the rates must be computed from the exchange rates between each of these two currencies, and the third currency, usually it's the dollar or the euro. So maybe I could also write that the rates, or is it important? So maybe let's assume, it's important, or maybe we assume an example, then it's going to be easy for us to understand. So the rates must be computed, well, let me just write. So the rates must be computed from the exchange rates between each of those, or each of these two currencies. We're going to look at an example. Let us look at an example so that we can be able to understand the cross rates, that you be able to understand the cross rates. So let us assume Australian dollar and the US dollar. So we can say that US dollar per Australian dollar is equals to 0.6. Is equals to 0.6. So let us. So what does this mean? That for one US or one Australian dollar, for each Australian dollar, it is going to be 0.6 of the US dollar. So 0.6 is the 0.6 is the cost of one Australian dollar. 0.6 is the cost of one Australian dollar. So let us assume that we also have the following quotation for the Mexican peso. The Mexican peso. So we have Mexican peso, the Mexican peso. So we have the Mexican peso. So we have the Mexican and Australian, no, Mexican peso, and we have the, let us assume that we also have the following quotation for the Mexican peso. Mexican peso and the US dollar is equals to 10.7. The cross rate between the Australian dollar and the peso is given by, and the peso so the cross rate between the Mexican peso and the Australian dollar is equals to Mexican peso and Australian dollar is equals to the US dollar per the Australian dollar, you multiply by the Mexican peso per the US dollar. This is for us to be able to get what? The cross rate between the Australian dollar and the peso, between the Australian dollar and the peso. Look, we have not been given, and it is not possible for us to get what? What is the value of 1 peso to the Australian dollar? But see, but what we have, because the dollar is usually most common, we have the rate between the US dollar and the Australian dollar. And again here we have the rate between the Mexican peso and the US dollar. Because we have the Mexican peso expressed in the US dollar, and we have the US dollar expressed in the Australian dollar, it is easy for us to be able to get the cross rate or the value of 1 Mexican to the Australian dollar, which we are going to get is given by the US dollar per the Australian dollar multiplied by the Mexican rate per the US dollar. We multiply by the Mexican rate per the Mexican peso per the US dollar. So which is going to be 0.6 times 10.7. That is what we were given in our example here, times 10.7, which is going to give us 6.42, which is going to give us 6.42. So what can we say? That our Mexican Australian dollar cross rate, our Mexican Australian dollar cross rate is 6.42. Yeah, our Mexican peso, sorry, our Mexican peso per the Australian dollar is 6.42. 6.42. So we can say that for 6.42 Australian dollar will cost 1 Mexican peso. Yeah, it's going to cost 1 Mexican peso. So the key is calculating the cross rate is to note that, or maybe we can just write that also. And just say that the key to calculating cross rate is to note that the basis of the quotation must be such that we get the desired results. So if we started with the Australian dollar versus the US dollar quotation of 1.67, that's actually just getting the inverse of what? The inverse of the Australian dollar. The quotation here, that is what is giving us 1.67. Yeah, if we started with the Australian dollar quotation of 1.67, we would have taken the inverse to get the quotation into US dollar versus the Australian dollar terms. So the key is to calculate the cross rates, is to note that the basis of the quotation must be such that we get the desired result here. So if we started with the Australian dollar, with the cost of the US dollar per each Australian dollar quotation of 1.67, of course, this means what? That for each US dollar, you pay 1.67 Australian dollar. You pay 1.67 Australian dollar. So the Australian dollar is much weaker than the US dollar. So if we started with the Australian dollar versus the US dollar quotation of 1.67, we would have taken the inverse to get the quotation in US dollar Australian terms for us to be able to express, for us to be able to get the Mexican peso. So another approach is to decide through, let's look at an illustration. So the spot exchange rate between the Swiss franc, we can look at another example, just for us to see whether we can understand. And if you don't understand, you can send questions to me. I'll answer them, or I can even do some examples and then send them to you. So we can say that the spot exchange rate between the Swiss francs and the US dollar, the spot exchange rates between the US dollar, the spot exchange rate between the Swiss franc, between the Swiss franc which is written as CHF and the US dollar is CHF per US dollar is equals to 1.7799, and the spot exchange rate between the New Zealand dollar and the US dollar So from this question, we want to see what is the spot exchange rate between the Swiss franc and the US dollar. This is the symbol for Swiss franc. And the US dollar is that 1.7799? Yeah. That means for the US dollar, it is going to cost 1.779. So for each dollar, it's going to cost 1.779 Swiss franc. And the spot exchange rate between the New Zealand dollar is New Zealand dollar. So for one New Zealand dollar, for one US dollar, it's going to cost 2.2529. So required, calculate the spot exchange, calculate the cross rate. This is actually the cross rate. Calculate the cross rate, or calculate the, let's say calculate the cross rate of calculate the cross rate of the Swiss franc and the New Zealand dollar. We don't have the rates, we don't have the rate of New Zealand dollar or the Swiss franc, we don't have the cross rates of the Swiss franc expressed in the New Zealand dollar. That is where we are going to find what? We're going to find the cross rate. We're going to find the cross rate because we have been given the rates between the Swiss franc and we have been given and the US dollar, and we've been given the rate between the New Zealand dollar and the US dollar. But we don't have the rate between the Swiss franc and the New Zealand dollar. And for us to be able to get that, let us do the calculation. Just do the calculation. The calculation is the CHF in the New Zealand dollar cross rate is zero actually. So that is how it is. But for each Swiss franc, for each New Zealand dollar, it is going to cost 0.790 of the New Zealand dollar. Yeah, for each Swiss franc, for each New Zealand dollar, it's going to cost 0.790 of the Swiss franc. And for now, let us stop there. We continue with the arbitrages, the cross arbitrage. We continue with arbitrages, location arbitrage, triangle arbitrage, and covered interest arbitrage. So see you next time, and thank you.